Hi, guys. It's Chad Larson with MLD Wealth. This is this month's podcast, MLD Money Matters, where I try to tell some stories, give some insights into what we see in the marketplace, touching on positioning strategies, and maybe leave some curiosity to thought over large investable thematics that we're seeing in the marketplace. I hosted a segment on BNN yesterday. This is my first crossover into mainstream media. It went well, and it was interesting. It was on market headlines, and so I didn't have anything prepared to talk about, and uh, but it all dovetailed together into something that I really wanted to hammer home today. As you know, on the podcast, aside from overall positioning strategies about what we like and what geographies, segments, thematic sectors, we've been making some kind of bigger calls on investable thematics. We've just, the gold trade has worked out incredibly well for us. We've discussed the energy trade in last month's podcast with Dave Zabunka from Canoe. I've touched on the infrastructure trade around AI. We've talked about international equities, private credit, and I think more so what makes MLD unique is our very high IQ, which is not intelligent quotient, that too, but more an implementation quotient and identifying themes and thematics that are investable and making sure that we're positioning our capital in front of these. So there's a not a new topic, and it's something we've integrated and invested in across core portfolios and made a strategic tactical allocation. But I'm going to talk a few things, but first I want to talk about today, which is a big one. You're going to likely hear me talking about this, ad nauseum for the next part of the market cycle. We talked about being 5 years into an energy super cycle or cycle, as I was so corrected to doing. But what I want to talk about copper now, from commodity cycle to strategic bottleneck, and some of the taglines I've been saying, in and around the idea of like, why am I talking copper? And I'm talking about artificial intelligence, like, you're all over the place, and actually I'm not. The limiting factor for AI is not going to be ideas; it's going to be power. And the digital economy is becoming physical again, and I couldn't be more excited about it. I had a great conversation with a client about an hour ago, and I said, I've never been more excited about the marketplace because I feel like the next 5 to 10 years is going to make sense. 10 years ago, going to sleep at night, somehow realizing I was invested in Snapchat as part of my retirement plan was unnerving. The market used to be about eyeballs and clicks, and yes, the market is still being driven around technology, but the digital economy is becoming physical again. I think in the end, the AI, it's an industrial boom, just wearing a tech label. So, I'm going to dive into copper here for a little bit. So, again, before I dive deeper into the AI and earnings, I want to spend this time on what we believe is the most underappreciated macro investment theme of the decade, and that's copper. Because copper is no longer just a commodity. It's becoming a strategic bottleneck asset. And that distinction matters enormously of how portfolios should be positioned. So this is not, I think, a repeat of prior copper cycles, Dr. Copper. And I challenge any of you to, Google copper as an investment theme. A lot of people talk about Dr. Copper as having like a really good insight as to the economy. So this misconception, when you hear about a copper bull market, people instinctively think it's China stimulus, it's property cycles, it's global PMI rebounds, and previous copper cycles were cyclical, they were China centric, and they were highly elastic, both on demand and supply. And this cycle, I think, is fundamentally different. Today's copper demand is policy mandated, it's legislated, and it's capital budgeted years in advance. So again, it's that electrification, grid hardening, AI infrastructure, defense systems, and these are non-discretionary projects. They don't get canceled in recessions. They get delayed and then they get accelerated. And that distinction, I think, is critical. So copper demand is now physics driven, not price driven. And here's the core idea that investors consistently underestimate, in my opinion. The energy transition and digital economy are copper intensive by physics, not preference. Some grounding data points: EVs use roughly 4 times the copper of internal combustion vehicles. Wind and solar require 5 to 8 times more copper per megawatt than fossil fuel generation. Grid expansion and reinforcement account for 40% of incremental copper demand through the 2030s. So, hyperscale AI data centers are extremely copper dense due to power redundancy and thermal load. And here's the key: there is no scalable substitute for copper at these power densities. Aluminum works in some applications, but not at the voltages, reliability, and efficiency required for AI clusters, national grids, and defense and aerospace systems. Back to other themes that we've been talking about. So this copper trade really plays into, I don't want to call it a trade, it's a positioning in and around where we see a lot of economic activity driving through the next market cycle. I guess I will turn off my phone. Apologies. Um, so this is why copper demand visibility is unusually high for a commodity. Governments have already budgeted for it, utilities have already planned for it, and corporations have already committed capex. So supply is structurally broken even at higher prices. So in talking supply, because this is where the super cycle becomes unavoidable, copper supply is constrained on these three non-cyclical dimensions. Geology: average global ore grades have fallen from 1.6% in the 1990s to 0.6 today. Lower grades means higher capex, higher energy input, and diminishing returns. Time: discovery to production timelines are 15 to 25 years. Even projects approved today will not materially impact supply this decade. And capital discipline: after the post 2012 mining bust, majors prioritize dividends and buybacks over greenfield risk. And then we have ESG and permitting constraints that further slow development projects. So the result is that copper supply is inelastic by design, not temporarily tight. Higher prices don't quickly bring on new supply, they merely prevent decline. That creates a structural price floor, not just upside volatility. So, copper has quietly become a strategic asset. This is subtle but critical evolution. Copper is now being treated by governments as a critical strategic material, not just an industrial input. We're seeing copper explicitly included in critical minerals frameworks, strategic stockpiling discussions, regional inventory controls, trade frictions reducing global fungibility. In other words, copper inventories are no longer fully global or interchangeable. This inventory fragmentation creates regional shortages, even when global inventories appear adequate. Premium pricing for near term physical supply, a backwardation in pricing curves, and higher volatility, but also higher scarcity value. Scarcity has been a word that I've been starting to really use a lot in identifying long term trends and investable thematics. This starts to resemble uranium or rare earth dynamics, except copper demand is vastly broader. Geopolitics add a persistent risk premium. Over half of global copper supply comes from jurisdictions with political instability, rising tax and royalty regimes, water and environmental constraints, community and permitting challenges. Chile, Peru, and the DRC dominate supply and all face increasing political friction. That means copper assets in stable jurisdictions with permits, with existing infrastructure, are no longer just productive assets, they're strategic. Markets tend to underprice this until something breaks. So, why prices must reset higher and stay there? This brings us to pricing. The market still treats copper as mean reverting, but incentive pricing tells a much different story. To offset declining ore grades, compensate for geopolitical risk, and incentivize new projects, copper prices must remain structurally higher than in prior decades. Increasingly, long-term incentive pricing is cited in the $12,000 to $15,000 per ton range. Sub $9,000 copper does not solve the supply problem. That's not speculation, that's math. So why copper belongs in strategic portfolios? This is why we don't view copper as a trade. In portfolios, copper functions as a real asset inflation hedge and a hedge against energy transition cost inflation, a diversifier relative to equity and bonds, and a long duration structural theme aligned with government spending. Unlike gold, copper is economically productive. Its demand rises with real capital formation. Volatility is inevitable, but volatility is not thesis failure. So I'm going to tie all this back into what I've talked about, AI and some earnings calls that I was just on, and this is where the copper connects to everything. AI doesn't scale without power. Power doesn't scale without grids. And grids don't scale without copper, which means the copper super cycle isn't separate from the AI story. It's embedded underneath it. And that's why understanding copper correctly matters before I'm going to talk about Palantir and Microsoft and AI duration risk and portfolio construction in this new regime. So, yesterday when I was on BNN, I said Palantir's earnings were going to be the litmus test to the AI trade, whether it was broken. Over last weekend, there was a lot of debate and chatter within the marketplace that NVIDIA had a potentially $100 billion transaction into OpenAI. It's kind of this big, the octopus eating its own leg, this big circular economy of the chip makers investing in the tech companies and tech companies investing in the um chip makers, and it's just this big round circle. And I think Wall Street was starting to wonder, like, where's the duration in this? But Palantir's earnings were more than just a company specific event. I think they were a signal to the market. So I said yesterday what was going to happen, in this trade was really going to dictate if this trade was not broken but delayed. And Palantir, what Palantir showed was not hype; it was execution. The stock's on fire today. So further validating what's happening. So the key takeaways: revenue growth driven by real enterprise adoption, expanding margins, clear evidence that customers are moving from pilots to production, and AI being deployed in mission critical decision making, not just experimentation. So this matters because markets are now demanding proof of ROI, and that's return on investment. For such a long time, it was about this huge TAM, this huge total addressable market. It was, don't worry about the math, this is going to be huge. And that was the last and first cycle of this AI trade was, guys, don't worry about it, hold my beer, this is going to be big. Well, it is big. But now investors are demanding return on investment. And, for the last 18 months, investors rewarded just the mention of AI and big CapEx announcements and ambitious roadmaps. Now they want revenue attribution, operating leverage, customer retention. And Palantir sits squarely in that show me category. It's not about selling abstract AI, it's about selling outcomes, faster decisions, lower costs, operational efficiency in defense, healthcare, energy, manufacturing. This, we are living in an absolute revolution of how business is transacted and the decisions are being made. And this is why Palantir is emblematic of the second phase of AI investing. It also helps to explain the reaction in another AI heavyweight, which is Microsoft. Microsoft last week printed their earnings and the stock got hammered over 10%. Microsoft is a big company to go down 10%, but it was a great print. And a print, I mean, it was great results, but bad stock market reaction. So why? Microsoft delivered a strong earnings print by almost any traditional metric. Revenue up, cloud strong, AI demand accelerating. So why did the stock sell off? The answer lies in duration and payback. Microsoft is spending tens of billions of dollars on AI infrastructure, data centers, GPUs, power, cooling, long lived assets with multi year depreciation. The market's concern isn't whether AI works, it's when the returns show up. I lend you money, I invest in you, no problem. I know you're going to pay me. When? So, in other words, CapEx is happening now. Monetization is spread over years. Margins may compress before they expand. This is classic duration risk. In a world where rates are higher for longer, markets are less forgiving of long payback periods, front loaded investment, and delayed cash flow inflection points. So, this doesn't break the AI thesis, it refines it. It becomes the show me market, and it reinforces why portfolio construction matters. Balance growth with cash flow. Blend infrastructure with monetization. Avoid concentration in the longest duration assets, which brings us to the asset class that has quietly done exactly what it's supposed to do: gold. Listen, gold last Friday to gold today and to gold a month ago. I made the analogy yesterday. It's like there's a meme on the internet, and it's Matthew McConaughey, handsome gentleman. There's a picture of him driving his Lincoln, cool day, breezy hair, looking handsome, and it says $4,800 gold last month. And the picture below is Matthew McConaughey in Dallas Buyers Club, like dying of an incurable disease, disheveled, gaunt. And it says, this week, gold 4,800. The market just moved so fast, had one little pause. The air came out of the trade. It was like the best airplane ride ever last year. And even in the front part of the year, I've never seen performance like this. So, the rocket ship and the plane is going up like this, hit one pocket of turbulence. Plane doesn't break, but everyone's panicked. So that whips on volatility and conviction. So gold was frustrating for a lot of investors because they pile in at the end. So there's sharp rallies, sudden pullbacks, and headline driven volatility. But that whipsaw is precisely why gold works in a portfolio, not as a trade, but as an insurance asset. Our bullish stance on gold has been rooted in three structural drivers: persistent fiscal dominance. Governments are running deficits that are large, structural, and politically difficult to reverse. That's bullish for real assets. Central bank demand. Central banks, particularly outside of the US, continue to accumulate gold as a reserve asset. This is slow, steady, and price insensitive demand. And monetary regime uncertainty. We're in a world where inflation is structurally higher, rates are volatile, and policy credibility is questioned. So gold thrives in uncertainty, not clarity. So, yes, a new Fed chair was announced, Mr. Warsh, who's traditionally been more hawkish. From a jargon standpoint, remember when I learned what hawkish and dovish meant? It meant I knew more than, I guess, 99% of investors. But it's very simply, hawkish is very aggressive because hawks are aggressive and attack. And then doves are kind of relaxed and more easygoing. So Mr. Warsh was typically more hawkish in his comments and minutes with the Fed over the years, within his different committees that he sat on. And so, if he was going to structurally really crank down interest rates, that would bode well for the US dollar, and it would like really hamper, gold prices. So I think the market used that moment to flush a lot of margin, flush a lot of leverage out of the system. But importantly, gold has contributed meaningfully to, lowering portfolio volatility. I would argue last year it's increased portfolio volatility, but added, attribution and performance so far in advance of the volatility that it remains muted. Better drawdown protection and stronger risk-adjusted returns. So it hasn't moved in a straight line, but it's done its job. So, in conclusion, to bring it all together, when you step back, these themes are all deeply connected. Copper is the physical layer of electrification and AI, along with things like uranium and lithium. And I've mentioned before, we run a portfolio around MLD AI. We can talk. There's a lot of information on our website about that. For anyone interested in taking more of a concentrated approach to this infrastructure of AI thematic. The AI portfolios must evolve from hype to economics. We talked about Palantir showing what real AI monetization looks like. I touched on Microsoft's reaction, reminding us that duration to returns of capital matter, and that gold continues to anchor portfolios in a world of uncertainty. So this is not a market for passive thinking or narrative chasing. It's a market that rewards structural analysis, patience, and thoughtful portfolio construction and implementation. Cycles don't end because they're obvious. They end because they're overbuilt. And across copper, AI, and real assets, we are nowhere near that point. That's why conviction matters. Guys, thanks for listening. If you found this useful, share it. Subscribe for more. And as again, for the private clients of MLD, we're always here to answer any questions, calm any nerves, or give you any commentary that you find helpful. Have a wonderful month, and I look forward to speaking with you all very soon.